Yes. Okay. Now, so yesterday we spent a lot of time on the of something which was very surprising, is that the bank, the central banks, the regulators, the supervisor didn't pay enough attention to the management of liquidity, and we have had a lot of issue coming from poor result in that. And if you lack liquidity, it's the end of the game. I remember for maybe 1 week before bankruptcy of Lehman Brothers, and we will discuss Lehman Brothers. The CEO, Richard Feld, mentioned to the press in a press statement that he had ample liquidity. Ample means 40 billion, 40. It was going down a lot, but still 40 billion, it's 40 billion. And but what he didn't tell, what he didn't tell to investor is that a huge part of that was already committed in other banks, was already promised to other banks. So in fact, the real liquidity was 6 billion, and after a couple of days, they were bankrupt. So the market views that each time somebody say, okay, my liquidity is good, I have no problem, and you have a lot of rumors, a lot of smoke of events, it's the end of the day. It's a little bit like oxygen. You need to have it. If you don't have capacity to breathe, then obviously it's something bad. Now we will move to something broader, which is the capital management. And the capital management was in fact more older. It's something which is a preoccupation, which is on the agenda of the regulator for a long time. The issue is that we have cycle of regulation, deregulation, and re-regulation. So the framework of the capital agreement change a lot according to this phase. These phases are very broad. It could be 20 years, it could be 30 years, but it's still something which is producing effect at after a certain time. And then the one thing which is very different from Europe and US, and obviously US have a lead in that, and UK too, is that they pass a lot of the activity of intermediation within the market. 80%, 80, is done by the market, and only 20 is done by bank. So it means that the bank can originate, make the loans, etc., but they will pass the loan a little bit like Northern Rock. And in you have a lot of non-bank actors doing the banking, the financing, and intermediating the saving. So in the US, it's very much a market economy. Outside of US, even in UK, it's very much a banking economy, and that changed a lot, because if you regulate bank, you regulate only 20% of the activity in US, and you regulate something which is much bigger in Europe and other countries. So we had phase, and regulation. The view of the regulation is first to protect the customers, because customers are supposed to be naive. I don't know for you, but for me, the first time I opened a bank account, it was the bank next door to my house in Paris. I didn't make a choice or a big search. Okay, it was couple of years ago, but I was not making a search. I wanted just to have the bank on a convenient location. And it means that it's not a very good criteria in terms of solidity, solvency of the bank. And because investors, savers, household with current account are supposed to be naive, they need to be protected. And then obviously the other thing is that banks made loan to each other. You remember even in Vietcombank, but very much at HSBC, you have a huge amount of loan, interbank loan, and you have a huge amount of financial instruments which are moving from one bank to another, and that's creating a lot of links. So the big nightmare of a regulator is that a big bank fail and that all the system fail. And in order to avoid that, they pay some attention to financial system strength. And then the other area for regulation is that you remember banks are creating the money, and then you want to have a view, you want to have a say in terms of welfare, in terms of say orientation of the economy, in terms of say income distribution. You want to have a say in the capital and risk allocation. You do not want the bank working just for the rich people, and you want the bank to allocate money to say good project or welfare project. And the thing is that obviously you can do that with a state-owned bank. A development bank can do that and focus on specific project which are very much wanted by the government. But it's also a possibility to twist that a little bit with the regulation. The danger of regulation is that if you do a lot of regulation, you put a lot of barriers to entry. So it means that you favor oligopoly and an oligopolistic situation in the market. And if you have a 20% of your market, the other one have 15, 21, 23, it's nice. It's a club. You don't need to do a lot of innovation. So it's prevent innovation too. And the market could be not very liquid, not very efficient, also in terms of allocation. So it's good, but it has a lot of danger. And during year there were a debate. So as I say, between regulation, low, strong regulation, low regulation, soft regulation, and then the main axis of the debate was between competition and solvency. And that happened in the Glass-Steagall Act in the US of 1933. After the big crisis of 29, the US regulator were created, and then they start to have a policy to prevent competition. So they say bank with a saving account cannot enter the investment bank activity, because with saving account you have a lot of depositor, say naive or with a low appetence for the risk, and if you move to investment bank you have very risky project. So then it was very soon a view to put the regulation there. And the one thing which is making that difficult is that the complexity of the financial instrument made the follow-up, the monitoring quite difficult. We discussed about derivative yesterday. Derivative were more or less not existing prior to the 50 years ago, but or 60 years ago. But they were in very old time in China, Mesopotamia, whatever, Greece. There were a lot of option product, but they were not restricted or mostly done by the bank. They were done by rich people to play a little bit with the future value of the crop in agriculture. So it has nothing to do with what we have today. And but complexity is very important. Incentive is also very important. If you pay people to take risk, obviously they will take risk, and it means that it's not probably an optimal outcome for the system. The one of the reports in the US was I put that at the end. Heads, I win. Tail, the other part of the money, you lose. I win because I take risk and I make money. And if it's the other side of the currency, then everybody is losing because you will rescue me. So then it's a very bad outcome. It's a very nice example of moral hazard. So it's not something we wanted to push. And the modern regulation was born in the US just at the end of the Civil War, of the secession war, and they were creating a couple of institutions in order to review the bank performance, and they had something which was a ratio. They managed the bank with a ratio which is a leverage ratio, and the leverage ratio compare the equity to the asset, or the asset to the equity. And if you compare equity to asset, usually they believe that 10-15% is okay. And so even today, with a Basel framework regulation, it's still an option. They can opt in. The smaller bank below a certain size of balance sheet, they can opt for a single and simple regulation, a single tool and simple regulation with a leverage ratio which is above 8% equity on asset, or above 9 or above 10, depending on the period. So that was the heart of the modern regulation. Outside US, regulation was much less demanding, and this concept of leverage is very simple to understand. Imagine that here you have equity 10, asset 100. So the leverage ratio equity on asset is 10%. You have profit of 1. Return on asset is 1 on 100, i.e. 1%. And return on equity is 1 on 10, i.e. 10%. And leverage is 10. So this ratio were supposed to be really the good level of a bank performance. But even with that, in the US, there were a lot of crises, there were a lot of problems. In the early in the late 19th and in the early 20th century, and also because you didn't have a central bank, the Federal Reserve, until 1913, and you have a lot of story on that. It was created on a secrecy plot, and so you have a lot of view. And the guy behind the creation of the Fed was John Pierpont Morgan, the acronym of JP Morgan today, the bank, and he was fighting a lot to create that. Now, assume that you change a little bit the leverage. Take the same bank, same asset, same return, so 100 of asset, 1 of return. Assume now that the rate are low, close to 0, and that equity is now 5. So I will ask you, the question is equity equal 5, and then the possible solution are bear with me 1 second, then I put like okay, so I propose you 4 outcome. So we move the equity to 5. And then we want to recompute return on assets, return on equity, and leverage. So you have 3 options, and another one saying none of them. So you remember the first one was return on asset 1, return on equity 10, leverage 10. It looks intuitive, it's not so intuitive. Should we have a little bit more answer? 9. Ten. Can you contribute a little bit more? Okay, 15. 15 is okay. We'll stop here. So you say here that none of those answers are convenient. So if we, which is a right answer, we will look at the first one. Return on asset 1%. Yes, we have 1 of net income, same return, same asset. So returns at the same bank. So return on asset is 1%. Return on equity, we have 5 of equity, and we have still 1 of return of net profit. So 1 on 5, that's more 20% than 5%. And leverage, if we take the ratio, the equity on asset, we have 5 on 100. 5 on 100, it's 5%. So it could not be the A, it could not be the B, because the return on asset is not moving, and it cannot be the C. Sorry for the typo EOR for return on asset. The return on asset is okay, the return on equity is okay, but the leverage is not. So you see, this is something very important. If you increase the leverage, so if you increase the asset for €1 or $1 of equity, obviously, everything being the same at the marginal way, you increase the return for the equity holder. So the equity holder love to have such thing, because it will create a higher return. But the one not loving that are the debt provider, because if you put a lower leverage, it means that again the wave and the dam. Imagine that you have a dam in New Orleans to protect the border, the coast. Then, if the wave size is 8 meters and not 2 meters, obviously it will go over the dam. So the level of the dam is a protection for stakeholders, in a sense. So it means that this thing is something which is very important, which is, if you control the leverage, you control part of the performance of the company for the different funds provider. And but despite the leverage, U.S. bank had a very bad performance in over the year. Here you see you have something which is equity on, say, loans. Uh, they are not perfect, but you see at the beginning of the period, equity was around 25% of loan in the purple curve, the US, and it's going to something like between 5 and 10. So you have a huge increase of the leverage. Yeah. So the leverage ratio as say equity on loan is going down, but that's a huge increase of the leverage. And apparently on some of the number you can have the same trends in the UK, the blue lines. So this is something which is uh, which is quite nice to have in mind, because uh, the when you had problems in some say banks or banking system, the US always wanted to bring back the leverage. They had much better results. So the place where they have the worst results was this 1000, 1020. It was really a bad performance, but then after it was okay, after 29. And then they were able to live with a low level of capital or high level of leverage. And globalization created a lot of pressure for something which is an international harmonization. And the US bank were not very happy in the 60s because the Japanese company were invading US. They were more successful. They had a lot of the Toyotas, the Honda, etc. They had a lot of success. And in Japan, they have very few capital because maybe you remember, we say within the Keiretsu, the Japanese conglomerate, they don't need to have a bank with a separate bank with the capital. The capital was the capital of the group. So you could have a chemical, a cement, a pharmaceutical, a car company, plus a bank and a trading company. So it means that these banks were not obliged to have a lot of equity, and they came in the US first to serve the Japanese client, but then they moved to US clients. And when General Motors talk to Citigroup or to Bank of Tokyo, if Bank of Tokyo don't need to have a return on capital, they will offer a much more competitive rate for a loan or for a facility than Citigroup. So US Bank were complaining, and then there was an event, a key event, which was the bankruptcy of a German bank, Bank Herstatt, in '74. And this bank was a very small bank, and doing the trade between USD, and at that time the currency of Germany was Deutsche Mark, and they were doing a lot of trading on both currency, and this bank bankrupt or was close to bankrupt. They made a huge losses, and the head of the bank is a trader. So the temptation for a trader is to say, okay, I lost this time, but I will double my bet and be safe. So he doubled his bet, and the bank bankrupt. Because at that time you have no internet, no fast telephone, you have fax, telex, thing like that. The U.S. banking system was continuing to work during the day when it was the night in Germany, and the bank already has bankrupt, the Herstatt Bank, and then it was a total mess in New York, where the bank doing the counterparty, the clearing of the USD were sitting, and it was really a mess. During a couple of days, I believe 3 days, the Federal Reserve was obliged to provide liquidity to all the bank until they have a clear idea of who owns what, and this loan, this commitment is to whom, etc., etc. So then the US pushed a lot, saying, no, no, we cannot be dependent on that. They wanted to have a regulation for international banks only. And that's very important because the foundation is for international banks. And when international regulation ID came out, they choose a BIS in Basel. We talk a little bit about BIS and Bank for International Settlement. And they were trying to create so Erstadt bankruptcy was 74. They were meeting in the late 70s and early 80s. They came out with a proposal for regulation. They came out with what is now called Basel I. And the idea of Basel I is to say we should have a minimum capital in order to control the leverage. And you remember, US banks say a leverage between 10 times and 15 times. So if you put the equity, if you put, sorry, the asset on the equity, it's something which is okay, which is acceptable, which is a good performance for a bank. So they took the mid-range. Mid-range was 12.5. 12.5 expressed the other way, which is equity on asset, is 8%. And the key of the thing was to say we want to have banks to have 8% capital on their total asset. Then came the differences between US banking system and non-US banking system. And they say, okay, we want to have 8% for sure, but we will take here something which will be 4% for something which is the core capital, and we will put another 4% completed with something called tier 2, and they get to the 8% minimum ratio. But because they were discussing with a system very different, the German, the Japanese, even the British said, no, it's not fair because we don't have the same risk in €1 or $1 of asset as not the same risk in the US and outside the US. So they say here, we want to have something which is a clever concept, which is a risk-weighted asset. So risk-weighted asset, RWA, is an acronym you cannot miss on any report, or it should be sometime total risk weighted. So you have other name, but the most used name is RWA. And this thing is that they will establish a minimum for all international banks. It means that if you are not an international bank, if you have very few activities or no activities at all outside of your country, you are not submitted to that. Then there were a lot of discussion saying, should we put all our bank on that because it looks good? But the one thing is that couple of systems put all the bank, like in Europe, and other systems put only the international bank as stated by the agreement, like US. So you have a divergence immediately. And another thing which is quite important here to understand is that the goodwill, goodwill is the amount you pay on the top of the book value when you made an acquisition of a company. So if you acquire a company for 120, and if the book value of the company you acquire is 100, normally the goodwill is 20. You have very good reason to have this 20 of goodwill, because you expect cooperation between the two banks, because you expect cost reduction. You have you have two HR, now one HR, one legal system, two legal system, one legal system, etc., etc. So you can make some cost gain, cost efficiency, and often it's labeled as synergy. So we will discuss that later also on merger and acquisition, but goodwill is immediately deducted from the bank capital. So if later on you say, I'm not very comfortable with this company, the result have which was acquired a couple of years ago. I depreciate the goodwill. The accounting term is impairment. I depreciate it. It has no impact on your solvency ratio because the solvency ratio is already deducting the goodwill, and that's something we will discuss later on the on the on the session 6 or 7. There were immediately a lot of criticism. They were, because the idea of Basel I was to say this category has a risk, has a weight of 100, the other one of 20, the other one of 50. You can play a little bit, and that's the arbitrage was immediately recognized. And also one thing which was uh, obvious at the very beginning is that if you are a bank searching for yield, for performance, you can take a higher risk. If there is no differentiation within the Basel I category, it means that your temptation is to take the asset with a higher risk in order to have, you have the same equity and you take the asset with the highest risk, and then you have a nice return on that. And so your return on equity is increased by the fact that you take more risk. Okay, so that's also linked to the bad granularity. We will look at that later. The other point of discussion was market risk. There were a lot of discussion about saying that the sovereign security, so the govies, the government bond security which are on your balance sheet, has to be weighted 0 because the state will not bankrupt. And so it was okay, maybe realistic for US or Germany, and even you see in US they are fighting against this maximum cap for the debt, etc. Obviously, we do not believe that US will bankrupt, but you had a more fragile country like Argentina bankrupting. And then securitization, which is the one we saw on Northern Rock and we saw on Santander NSFR ratio. Securitization was not properly addressed in that regulation. And this is an example of arbitrage. You have, as soon as it's on the mortgage market of the US, the blue IRA, the dark blue IRA, is the proportion of the mortgage intermediation done by Fannie Mae, Freddie Mac, the US agency. Because in terms of Basel, if you had the guarantee of Freddie and Fannie, you don't have any weighting on your loan. So you see, as soon as the regulation starts, a lot of the activity was moving to this agency with a full guarantee of the state. Well, be sure that it was a dangerous game. Those two agencies bankrupt in 2008 after Lehman, and they let total cost to be weathered by taxpayer of around 300 billion US. But at that time, it was not viewed as too dangerous. The one thing is that also on Basel I 5, there was a reflection about this security, the sovereign, the corporate bonds, etc. And the idea was to use a value at risk. Value at risk was a concept created by JP Morgan and Bankers Trust at that time. And they were saying, according to a certain assumption on the portfolio, we take all the trading portfolio, whatever the security are, and we look at the historical volatility. And we try to say that, you see the little curve here, we try to say, to fix a barrier and to say here, the loss will not be above that in 99% of the cases. It's very nice. Okay, it's a good information, etc. You manage your trading book with that. However, the one day which is after that, it could be here. Okay, nice, but it could be here. So it means that what they ask the bank to do is to say, okay, normally your losses are not above that level, the blue line, and we will take the blue line, multiply by a certain amount, 3, 4, 5 times, and we will say that's the equity level you should have, because this should be the maximum losses according to your distribution. So this is a nice management tool for a trading room, and obviously you are very interesting to understand the losses, the gains, etc. Obviously, you are more interested in losses because it's there that you have more needs or requirement of capital. But here it means that this value at risk is very dangerous because we don't know where is the final outcome. Is it there or is it there? And it has a huge difference. And the bank push to have that as a, say, regulatory tool, not only a management tool. By the way, the two banks were creating the value at risk, JP Morgan and Bankers Trust, made more or less huge losses on trading and were rescued. JP Morgan, you still have the name, but the current CEO, Jamie Dimon, was the CEO of Bank One, and they merged with JP Morgan, which was in really bad position, bad shape, maybe 20 or more than 20 years ago. So they kept the name JP Morgan, which is much better than Bank One, and then they fail on the management due to following this tool. And then the same for Bankers Trust. They were purchased by Deutsche Bank in the mid 90s, and again, if you have a very nice car, the temptation is to drive fast. So if you have a Porsche or a Ferrari, maybe that's a nice car, but the temptation is to drive too fast. So here you have this introduction on the Basel one. You have here a couple of graphs on what the regulator want to have. So they say, okay, fine, you have the value at risk. This is Credit Suisse in 2005. So 2005 was an extremely good year, and you see the line is a value at risk one day. Then the regulatory one is a little bit different, and you see the experience within the trading room was never a loss bigger than the tool. So it's to say that the Credit Suisse value at risk toolkit was quite good, because even here they suffer huge losses on those days, and also here, despite that, they were able to be below the limit. And the regulators say, if your tool are not performing well, we come back to a more simple management of your market risk. And but in fact, they never developed the simple tool. And here, if you look at another one, you see that's Deutsche Bank, and the year is not as good. It's 2007, and you see in 2007, Deutsche Bank experience was below the predicted value at risk 1, 2, 3, 4, 5, 6, 7, maybe 8 times, 9 times. So it's something which is outrageous, and because the value at risk should allow you to be say out of the range for maybe a couple of days, but not 9 or 10 days. So usually we estimate that it's 2 or 3 days. So this is something which is bad. And then due to that, the regulator had the discussion and say, okay, we need to reframe our regulation, maybe to ask a little bit more for market complexity and a little bit less for loans. And then here you have the framework of Basel II, and the framework of Basel II is exactly the same than Basel I for the market risk, Basel 1.5. So it's based on the value at risk. You have the credit risk, and you have the standardized approach, which is very close to the Basel one. And then you have the introduction of two other models, which are internal models. And you see the internal model is a little bit in the coming from the idea of the value at risk. You use internal model on your trading desk. You have a review of your risk, your performance. Why not using your internal tool in managing the credit risk? And so here they were moving to something which is foundation and advanced internal model. And this was reducing a lot the capital need. And the discussion on that was 2004, but the text was published in 2004, but then the implementation was supposed to be 2007 or 2008. You see, retrospectively, it's not the best thing because you implement it on the middle of the big crisis. So it means that this is something which was reducing the capital needs of the bank. And in order to offset that, you create a category of operational risk, which increases roughly the risk by 10%. But even with that, the needs were going down. And so if you look at that, the Basel II model was based on something which is quite innovative, which is to do something like the approach by the rating agency. The rating agency look at the probability of default of a counterparty. So the banks were asked to use the same tool than the rating agency in their portfolio and to look at the loss in case of default. So loss given there is a default, LGD. And then this is something that today Moody's is using a lot, a rating agency, whereas Standard & Poor's is much on the probability of default. But then the idea is to say, estimate your expected risk on your portfolio, transform that on an internal model, and then you will be able to use it as a regulatory capital requirement, which is nice because you align the internal model and the requirements. So, however, the bad thing is that it was made on at a bad time, and U.S. supervisors, which had problems with very early in the crisis, say no, we will not implement Basel II. It's too complicated. Let's see the next one. So that was the main thing. And we will do the exercise on Basel capital computation. But before, I wanted to show you an example, a past example of implementation of Basel II. You have BNP Paribas. BNP Paribas disclosed the risk-weighted asset and the capital by division. So you have the retail banking activities, the top line, and you see that the capital, so which is risk-weighted asset times 8, was, oh, sorry, I put that thing here. The capital here on the Basel one was 5.9, and then on Basel II it was 3.8. So it's a huge decrease of capital, and we will discuss that later. But you see, it has a huge impact, and as a total for BNP Paribas as a group, the reduction is 18%. So it's the bank were very favorable to Basel II. The bad thing is that they were favorable to a tool reducing capital at a moment where capital was not sufficient enough to weather the crisis. So I propose you to go and to do an exercise on the Basel computation. So I will And we will do the first one together. Well, it's a simple so the first thing, sorry for the colors. I don't know why they moved to such thing. Here, you have the Basel I weighting. You see, you have two categories of risk, one in OECD and the other one non-OECD. And in fact, the category at that time included Saudi Arabia, which was part of the agreement. So you see, if you have a sovereign OECD, it was 0. Then if you had a local authority, 20. Then if you have a bank, a short-term loan, 20. And then etc., etc. If you have a mortgage, 50. And any other loan, any other asset, 100%. And if you have, say, something which is non-OECD, there is only one category which is not weighted 100% here. So it means that it's a very simple one. It's a reduction of the real one, but the real one made maybe 50 different line and category OECD, non-OECD. So it's not a bad summary of what it was. In Basel II, the internal model, the standard model, you see the standard model are based on the external rating. The external rating came from a rating agency, Moody's, Standard & Poor's, Fitch, and sometimes you can have DBRS and a couple of other agencies, but the top three capture maybe 95% of the rating. So we focus on the top three. And you see here, if you have a corporate loan, it's only where you move toward a very bad ranking rating that you got something higher than 100. Before, in Basel I, you don't have any higher. You just have 100% as a maximum. Here, you have 150, but, and that's a but, the non-rated assets, corporate loans, corporate bonds, etc., are weighted 100%. So it means if you are very bad, you prefer to be not rated rather than rated, because you know that the bank will view with the glasses, will view you as an exposure dangerous if you have below B minus, and you will be with no difference from Basel I if you are not rated. So this was creating some strange incentives. And here you see mortgages. The rate for mortgages was for all the exposure 35%. You remember we were moving from 50 in OECD, 100 non-OECD, and then it's moving to 35 because mortgage, that was a big part of the bank criticism. Mortgage is not that dangerous normally. It should be very safe. You will have the capacity to capture the flat or the house if the household has a problem. So you can negotiate in good position. And you have an introduction of something which is brand new on Basel II, which is the CCF, which is a credit conversion factor, meaning that here you have for something which is not on balance sheet. Imagine that you made to a corporate the commitment to open a credit line of 10 millions. This credit line of 10 millions will be taken into account within the framework. And then you have the Basel II internal model. You do not have anymore the weighting. You just have categories, and within those categories, you have probability of default, loss in case of default. You have the CCF. You have a K coefficient, and you have a set of information which is quite different from the first one. So what we will look at is to go on to where is that one? Yeah. Okay. So here, I will let you look at this thing. I will provide you with the Excel file later on. You have a loan, which is a loan to a corporate client. You have 1,000 million euro, which is a big loan. You have a part which is on the balance sheet, and you have a part which is not in the balance sheet, so that's a line of credit. You have no provision, maturity is below 1 year, you have no external rating, and your internal rating is B+. So that's the characteristic of the loan. The question is, could you compute the capital required here on Basel I, Basel II standard, and Basel II internal methods? So you have maybe a couple of minutes, and we can focus first on the first one, the Basel I, and then we will correct the Basel I in 2 or 3 minutes. So normally it's quite simple, a piece of cake. Exposure on the balance sheet here, you have the loan. So sorry for my bad writing, but you have 400. Off balance sheet, you remember what we say? There is no introduction of off balance sheet on Basel I. So the total asset we have into consideration is 400. And the risk weighting, it's a corporate loan in Basel I, so it's 100%. Sorry for my bad writing. And because it's 100%, the risk-weighted assets are 400. Then the equity, in our, let's say, general view here, it's 8% of the risk-weighted asset. So here we have 32. Any question on that? It's simple. You see that that's a nice thing with Basel I. It's easy to apply. Then, I will let you maybe 2 minutes to compute the standard Basel II capital. So exposure is also 400 on balance sheet. Then off balance sheet exposure, you remember what we say, there is 600. The 600 are less than 1 year, and so it means that it's a 20% weighting. So 20% of 600 that's 120. So it means that my total assets are 520. What is the weighting of a corporate loan without external rating? It's 100%. So it means that here we have 120 of risk-weighted asset. And then we have 520, which times 8, which is 41.6. And here you see we just have more capital because we pay attention to the off-balance sheet. And then we have a totally different system here on Basel II internal model. On exposure internal, we still have the 400, no change. We have the off-balance sheet, and you remember for the off-balance sheet here, we take 75% of the exposure. So it means here that we take the 600 and we take 75%. So 75% of 600 should be 450, but I would prefer to check, not to put some strange thing. Yeah, that's 450. So you see the exposure is a little bit higher. So the EAD, the exposure at default, is the sum of the on and the off. And then we apply the PD of a category B+. The PD of our category B+ is here something which is 0.5, and so we put 0.5. The LGD here is something which is still on our B+, which is 35%. The LGD represents the amount we will lose in case of bankruptcy on the exposure. And the coefficient K, we will discuss what is a coefficient K, is equals to 5%. And with this 5% here, we have something we put here. So now, oops, it's really bad. So we have 5%. So expected loss, the first one, is EAD, so the 850, time probability of default, time loss in case of default. So we put an estimation saying, okay, our exposure at the time of default, the exposure at default will be 850. We will suffer a loss of 35% in such case. But the probability of default is very low, 0.5%. And so we move to capital, which is expected losses, which is quite low, which is 1,49. I round the number. We have no provision. And then the capital is required if the equity from the expected loss is equity, minus provision, but we don't have any provision, plus UL. And you see UL is exposure at default, so the 850 times 5%. So 850 times 5%, that's 42.5. So you see there is a huge component, which is in fact the UL, which is the unexpected loss. We will rediscuss those things. So total capital will be in fact 43.99. So here you see we have more capital required in the Basel II internal method. But it's not always the case. It's because we have a huge amount of off-balance sheet. So what I propose you is to do the same and to send it to Tram in say 6 minutes, 7 minutes on another case, which is another loan. You have 1,000 on balance sheet 800, off balance sheet 200. You have a provision, this case 250. Be careful. Its maturity below 1 year, it has an importance, and the external rating is B minus, and the internal rating is E. So you have, say, 5-6 minutes to produce that and to send it to Tram. If you have questions, feel free to ask questions. It's exactly the same sort of exercise than the first one. You will tell me when you have enough answer. And you can just give the answer for the equity if you want, because that's for Basel 1, Basel 2 standard, and Basel 2 internal. If you can give me only the part which is in yellow, at least on my screen, which is the equity on the top, on the first two, at the top, and the EL, the UL provision, and the capital requirement for the last one, the Basel internal. Tram, do you have already some feedback? We'll start again. I suppose that you have had some time to send it. I will send you another exercise to do for tomorrow evening. That's a very simple one, another one, and I will provide you with the answer during tomorrow class. Okay, so back on our discussion. The presentation we had with that one. Okay, it will come soon, maybe. Okay, here we are. So you remember this thing about BNP Paribas and the fact that they had some gain from Basel II. It was unfortunate because at the time of the crisis they had not enough capital, and it's because also they could have reduced capital. The Basel II default weaknesses are in fact summarized by this simple chart. When everything is going very well, you have full expansion of the economy. Your probability of default in economic expansion is low. The losses you got in case of default are also low. So the capital requirement is going down. So Basel II versus Basel I. So if it's okay, that's nice. Maybe that's a reflection of the state of the economy. However, as soon as the recession comes, then you have the opposite. You have more capital. Then if you have follow a very expansionary policy as a bank, you made a lot of loan, you are very happy to do it. It was improving your return, your profitability. You estimate that the risk of the loss is very low. So then it's something where you will be surprised as soon as we enter a recession. Because as we enter a recession, maybe you do not have enough capital. And at the time of a recession, if you ask your shareholder, the market, for raising capital because you don't have enough equity here, you move your equity on the purple line. So that was fitted for economic expansion, but not for recession. So if you go to the market and say, sorry guys, I need to have more capital, can you help me to have more capital? What would be the answer of the people? Yeah, sorry, we do not want to invest capital in a crappy bank. We have better allocation of our capital, of our funds, and so most likely, well, depends on the cases, but it's very likely that the investors say no, we do not want to help you. So if you do not have enough equity versus your asset, you need to sell your asset. And if you need to sell your asset, you are in a really bad situation. Because if you need to sell your asset, it means that you have a situation where maybe a lot of other banks were doing the same. So if everybody wants to sell assets at the same time in the market, maybe the price will not be optimal and you will make losses on your disposal. And something which was valued at 100 could be valued at 20. It's something we label fire sale. So this fire sale are the sales because you need really to save some furnitures in your house because there is a fire and then you need to go away with that. So because of that, that was a criticism on Basel II. And Basel II tried to reduce the pro-cyclicality. And for example, they introduced the fact that the LGD, the loss in case of default, will not be the loss coming from good time, bad time, but will only be the loss coming from bad time. So you have the probability of default that you have. However, the LGD, the loss in case of default, will be always the worst case that you experienced in the past or in your model. So it means that it's interesting, but it's very subjective. And so I put you, well, so some things on there, something you, well, for the time being, I will not comment that. And the thing you remember in Basel II internal model, we have a distinction between expected loss and unexpected loss. And expected loss, it's something which could be managed, whether unexpected loss, it's much more difficult to manage. So I will ask you a simple question. EL is managed. With so I put you a couple of so first we will look at expected loss. You see the one which is at the bottom part. Then if you are a bank, you can manage the expected loss with the margin, the yield you put on the loan, the size of the loan, because you can say if it's too risky, I reduce the size, or maybe you can ask for more guarantee, or maybe that's not none of them, and then you have to look at other criteria. So the floor is yours. Okay, I will close the poll. Okay, massively you say the guarantee, and you are not convinced by the size or the margin. The guarantee is something which is reducing the loss given default, because if you have more guarantee, obviously you reduce the expected losses. However, the most natural way is the one which is not intuitive. It's to say you move the margin. Imagine that you make a loan to a printing company, and you know that the printing company in your loan book made a loss of, say, an average loss on the cycle of 1%. So if you do not charge them 1%, you are dead. Obviously, you can sell other products, But if you are just looking at the profitability, the return of that product, then you need to have something which is a relationship between the margin and the expected loss. Obviously, the margin is not always a loan margin, and you're right to put the guarantees, the collaterals are also something important. If you are brave and you say no collateral, no guarantee, obviously you will attract more bad clients saying, okay, it's very nice. So the answer C is okay, but the real answer is A. To say it's very subjective because you need to have a view on what is a loss, and the loss of the past is not the loss you will experience in the next 1, 2, 3, 4 years. So this is a very difficult exercise, and your risk management center in the bank should give you the expected loss probability, the expected loss measurement on a category. However, if on the category you have printers, but you have a big one and a small one, most probably the expected loss is not the same. So it's also something very delicate because you have to class your portfolio in a relevant activities. And then another question on UL. So here, UL, you have 4 answers. Is UL managed with the margin, the equity, the guarantee on the loan as collateral, or the probability of a crisis? The wording manage is a little bit strange. It's a little bit not precise enough, but okay, we'll stop here. So you put crisis probability, but who we are here to assess the probability of a crisis? We could be genius, but we could be also very weak in making such prediction. So in fact, the only way you can really protect yourself from unexpected loss and not be, which are non-frequent events. You see, there are a couple of them with huge losses. It's to have enough equity. So in the Basel framework, the total loss is made by expected loss and unexpected loss. And the combination of the two is something you manage the expected loss by collaterals and margin, right? And the unexpected loss by maintaining an equity level. And all the philosophy of the Basel model will be to have, say, unexpected loss, which are protected by enough capital. So imagine that you had a storm destroying your house. You want to have more capital saved somewhere in order to rebuild or to move and to start again your life. So it's something very important, UL and EL. You have to think about the losses as a split between EL, which are managed by the, say, commercial activities, margin, collaterals, and the unexpected losses, which are managed by the risk department of the bank, creating an allowance, an assessment for the capital, for the equity. So we will close here and make a break. So enjoy the break, and like yesterday, we will do maybe 15 minutes break, and then we will further continue the lecture. So have a nice break. Hello, we will start soon, maybe 1 or 2 minutes. We will start in 2 minutes with a video of an expert from the Federal Reserve of San Francisco in the US, and is with a function of regulator, but is talking, I guess, the first 3 minutes, because the video is 12 minutes, which is a lot. The first 3 minutes are interesting for a topic, which is quite directed to the difficulties to do estimates. Okay, we'll start.
So what did we learn during the financial crisis? Well, what do we continue to learn from the financial crisis, I guess I should say? Well, to some extent, the financial crisis had its roots in excessive risk-taking from the banks. The ability for any firm to sort of understand the long-term performance dynamics of certain assets is very difficult. Even for assets that they have, even for types of loans and assets that they've invested in for a long period of time, it's just very inherently difficult to understand how that performance is going to play out over time for any number of reasons. There's always structural changes to markets. There's structural changes to the underlying dynamics of the economy. At some level, you could, I mean, I guess sort of a wonkish way of saying it is, a lot of the techniques that firms use to try to evaluate and assess risk of these assets are based on various statistical techniques, and a lot of statistical techniques have at their core an underlying assumption that the data generating process is sort of stable over time, and the data generating process that gives rise to things like loan defaults and the amount of loss you suffer in the case of that default, those things are not stable over time. There's all sorts of underlying dynamics that are always changing that make it very difficult to apply some of those techniques to evaluating financial risk and risks of different financial products. And then when you think about sort of the alphabet soup of new products, right? So that's true of mortgages and corporate loans and all sorts of things that banks have a lot of history in evaluating. When you think about some of the things that came up in the 2000s, all sorts of securitized products, CDOs, CDO squared, synthetic CDO squared. I mean, if you've looked at a synthetic CDO squared, I'm sorry for you. I've looked at a couple of them, and they just, they don't really make a whole lot of sense. I mean, at their core, these were leverage enhancing products that firms developed that had very little tie to underlying economic activity, and frankly, very little benefit to the core mission of banks, which is to try to match up savings of different economic actors to productive investments for those that need that capital. A synthetic CDO squared does little to none of that. So a lot of these products were not only very difficult to risk assess because there was very little history of them, but were at their core sort of leverage enhancing, which is sort of the idea that a lot of the roots of the crisis were really from excessive risk taking.
Okay, so that's the extract I wanted you to show and to share, and then I have say couple of questions on the video. And that would be yes or no. Okay, now you can. So what he say is that it's easy to assess risk in an era where the bank is active for a long time. Is that yes, no, or not really something he said? So you imagine you are active in, don't know, in oil and gas, and you are comfortable because you are an expert, you have a lot of people focusing on that, and so it's easy to assess the risk in the area you master, you monitor. Okay, we'll stop the survey here. Okay, so then you're right. The answer is no. He mentioned that even on an area where you are expert in, you are involved for many years, it is very difficult to assess the real risk. So it's obviously maybe it would be slightly better if you know the industry, you know the driver, but because it's the future and the future is uncertain, it's still very difficult. So then the second question is here. Check. Sorry, I made a typo. Yep. And then again, it's yes, no, I don't know. The core mission of banks is to develop innovative product, and he mentioned the CDO square as one of the most innovative products. Okay, we'll stop there. Then the answer is no. It's a core mission of the bank is to match the saving with the investment in project, in product useful for the society. And the CDO Square, CDO are collateralized debt obligation. They are quite complex products, and this is something which is linking the cash flow of certain assets onto a bond, a debt, which is a collateralized debt, which benefits from the protection, the cash flow of certain assets. But you can do that with part of the asset coming from that company, the other one from the other company. So you see, he spoke about the alphabet soup, and he spoke about the CDO Square, because CDO Square is an instrument, a financial instrument, which is investing in other CDO. And then it's very complex. And he says, sorry guys, it makes no sense. You made crazy thing, stupid thing. CDO Square were not authorized in all of the market, and I assume that it was not authorized at all in market like Vietnam, China, etc. But in US and UK, it was very much fancy, and this products are impossible to understand, to manage. The CDO prospectus is made of around 500 to 1,000 pages. If you want to venture onto what exactly is inside, what sort of cash flow you will benefit from, it's a huge work to do that. So usually people were not doing the job, and in fact the job was done by the rating agency, and then you have a stamp saying, okay, it's single A, double A, triple B plus, and then you have an ID, and the rating agency provide a risk assessment. But the rating agencies were totally wrong on that, and that was a big failure on the market. And the rating agency protect themselves, saying that they are providing an opinion, not an advice to invest in the product. You see, the difference is quite thin, but it means that in most of the cases, rating agencies were not made liable for the stamp rating, and we had parliamentary commissions looking at the way the rating agency were working, and in many cases they were just putting the stamps on the fast line. Each time they put a stamp, they made something like $200,000. So it's a lot, and it was not providing a reasonable opinion. So, and the guy was at the head of the San Francisco regulator, the Fed of San Francisco, and he was looking at the bank on a stress test perspective. But the one thing we need to have in mind is that he's not really happy with that. Okay, so now we move back. Where are we? So I want to be back on stop to, okay, then we put that here. Okay, so you see, this is something which is obvious, and This one was a video of 2017 or 16, so it's not something brand new. Obviously, now the bank had more tools. They can do a lot of things with intelligence, so I will not comment that. So the takeaway here is that the regulation for international activities work with single rule, principle textbook, but that the model, that's one of the great achievements, that's one of the weakness of the model, is that you say there is a model and I split EL and UL. And EL is something you manage with the commercial characteristic, collaterals, margin, other revenue. And UL is really the one thing you need to have in front of unexpected losses, and that's your equity. And another big thing is that if you do not want to change your leverage, you need to have a return on equity sufficient in order to guarantee your growth rate. Imagine that you have an asset, a balance sheet of 100. You grow by 10%. You have 10 of equity. Good. If your return on equity is 0, at the end of the day, you will still have 10 of equity and 110 of assets, which means that your leverage ratio is moving down. So if you want to develop the bank, you cannot long-term develop the bank with a return on equity which is below the growth rate. So if you want to have a growth of your asset of say 15%, you need to have a return on equity of 15. We will discuss that later, and it's an important outcome for emerging market banks, because in emerging market like Vietnam, you will have a lot of potential growth of the balance sheet. At the same time, if your return on equity is too low, that means that the leverage will increase or the leverage ratio will decrease. So if you do that, there is a floor. You cannot be below 8%. And at some point, you need to ask the shareholders to put more equity or to make an arbitrage between your businesses. Okay, so this is a takeaway of the session 2, and I will go on the quiz. Of the session 2. So it's trying to, okay. Then we have the question of yesterday. Now we have the question of today. Then the question 1, we will say yes or no. Risk-weighted asset system take balance sheet asset and liability and transform them on a weighted asset or liability, sorry for the typo, in order to take into account their riskiness. Yes, no. Okay, we'll stop here. Okay, you say yes. No, it's wrong, because that's a pitfall of the question. Risk-weighted asset system take the balance sheet asset only and not liability. You saw on the discussion we have, would just take the asset. So it means that the asset liability management is made by the focus on the liquidity, the first thing we saw. But then here, purely on the riskiness, we just look at the riskiness of the asset, because the bank collects the saving, collects the resources, and invests in asset. And the riskiness of the asset is a key thing. So there is no such thing like asset and liability. Okay, then the second question, which is yes or no. Basel regulation applies directly to all UN countries' jurisdiction. You remember that's an international regulation, so I will put yes and no. Okay, we'll stop here. Your answer is okay. It's wrong. Obviously it's a BIS, which is linked to the G20, but it's not a UN organization, and it's not because you are a member of the United Nations that you have to apply. It's a decision that the Central Bank of Vietnam should agree to take the Basel regulation, and then you can have your own speed, saying I will stay to Basel 1, move to Basel 2. You are not obliged to move to the most sophisticated one immediately. You have some leeway to do that. So now, question 3. It's again yes or no. The Basel II was increasing the capital level of the system. Okay, it's a useful set of answers. The answer is no. You remember the spreadsheet with BNP Paribas? The Basel II capital requirement versus Basel I was going down by 18% or 19%. Now I do not remember, and generally that was the case. And one of the key things is that the mortgage portfolio was weighted at 50% in Basel I, and you remember the table, maybe it's weighted 35% in Basel II standard. So this is a big difference, because mortgage portfolio are quite big in developed markets, and so it's no. Then the question 4. Question 4 is, due to the development of market RWA are dominant in today's US and UK system. You remember this framework we show on the Basel II. We have the credit, the market, and the operational, and the market. Okay, it's quite split. Thanks for the split answer. Obviously, market risk increased a lot, but then it still represents, in average, 10% of the total risk-weighted asset. Operational risk a little bit over 10, maybe 10, 15, and the remaining, the 75 to 80%, are credit risk-weighted asset. And even a bank like Goldman Sachs, which is quite active on market, has 1/3 of its risk-weighted asset on purely market. And you remember market, that's a trading position volatility, that's a VaR as an indicator of the portfolio volatility, and then you link that with the risk-weighted asset. So it's not, even if the answer yes is understandable, because it could be, it's on the rise. Then the question 5, yes, no. Before Basel I, international regulation was based on the limitation of balance sheet size. So it means that you could not, if you are a big bank, develop your balance sheet above a certain level. Okay, so thanks for the answer. The answer is no, apart from the US. So maybe if you focus on the US, the answer yes is okay because of the leverage ratio. But apart from US, before Basel I, there was a competition to increase the size of the bank. During years, it was a fight between Japanese bank and sometimes some European bank to be the biggest bank, to have the biggest balance sheet, in order to show their influence, and there were no consideration of things like balance sheet limits. But in the US, it was different because they were managed with the leverage ratio. Then question 6, which is again yes, no. Since the implementation of Basel framework, there was a sharp reduction of the size of the bank risk department. Sorry, I missed it. A sharp reduction. Okay, it's you're right. It's mostly wrong. There is a sharp increase in the risk department because you need to have models to develop capacity of people looking at the model, doing the interpretation. So it's something which is moving up. So 7 on operational risk. Yes, no, I don't know. Okay, then the question is a little bit weird. The formula is inspired by that, but it's not exactly that. Because you take litigation, and obviously the formula for litigation could be that, but you take also all the incidents. For example, you have a fraud, you have a trading issue. For example, when Société Générale had a rogue trader, Jérôme Kerviel, playing with its balance sheet, its position in a Delta One desk, he made a loss of around 5 billion euro. And that's not a litigation, that's just a fraud. You could have also issues on operation, which are internal fraud organized by your staff. It could be a fraud organized by clients you do not necessarily recognize immediately. So there are many issues. Or for example, you have an issue with your IT system, which is blocking the client account, and all those things account, not only the litigation. And last question about the rating agency place in the standard model. Okay. So the answer is yes. They play a huge impact. You remember the table, the first table with the weighting. There is this thing with the standard model, and there is a classification of the risk according to the rating, to the grades. So you have AAA, AA, single A, etc. And you have no rating. So a part of the no answer is that you could be viewed as right also, because a huge part of the exposure of banks was not rated by rating agency. So it means that a huge part of that could be without a rating, so without the intervention of a rating agency. So it's something I would say more yes, but the no, if it's for that reason, I can still understand the no. Okay, so now we move to the session 3. Oh, sorry, that's the quiz. So I will move to the other one. Then one thing which is say difficult is that due to the problem of 2007 2008, there was a huge amount of losses between 1 trillion and 2 trillion dollars of losses within the financial system, and due to that, it creates a clear diagnosis that banks were part of the problem. You see, on the COVID crisis, the recession, we say banks are part of the solution. But 15 years ago, the banks were clearly part of the problems. And due to that, there was a reform, Basel III. It's often labeled Basel IV by the bankers and by market, because they believe that it's a big change from what Basel III was. And the idea of Basel III is to both increase the quality and the quantity of capital. So there is a reform on the capital. There is a reform on liquidity, that's the one we saw at the very beginning, the LCR, the NSFR. So that's part of Basel III because the banks were too fragile. And then there are a systemic reform, which is often dubbed as macroprudential. You see, you have microprudential and macroprudential. And that's the first two are micro and the last one is macro. And there is a huge agenda. It's not totally finished. The final end of the reform would be 2028. So for the country, the region which are taking the Basel III agreement. So the main thing here is that you see we spoke about 8% total capital in Basel 1, Basel 2. But this 8% capital was tier 1 plus tier 2. Here, we forget completely the tier 2. And we say, in fact, you should have 10.5. And you remember, maybe we were quick on that, but the total capital was 8%, 4% of tier 1, 4% of tier 2. Here, the 4% of tier 1 is moving to 10.5. There is something called conservation buffer, but it looks like a buffer, nice to have. In fact, it's a must to have, because if you do not have fulfilled the conservation buffer, you cannot distribute dividends or pay interest to the members for a mutual bank. So really, the 10.5 is a must, is something you need to have. And so you see, it's a big difference. We used to have 4, and now the minimum is 10.5. So it's 2.5 times more capital than it used to be. And well, we will not venture onto the slide fully, but here you have a definition, a more strict definition of what is equity, what is not equity. And that was not done in Basel 1 or Basel 2. We have to wait until Basel 3 definition in order to be very comprehensive and very strict on what is capital. Here you have an example. Royal Bank of Scotland, who now is the NatWest Bank, is a British bank, obviously based in Scotland. If you look at the former name, and they made the acquisition of NatWest maybe 20 years ago, and just before the crisis, they wanted to make an acquisition of another big bank, ABN AMRO, and with the Basel II regulation, they had enough capital. They have 5.7 with a target of being at 6% and maybe 7 on the long run. They failed in 2008, and then they were nationalized by the British government. And in fact, if you look ex post, because this is something that a parliamentary commission has done after, the Basel III CET1 was just below 2%. So when you have a CET1 Basel III just at 2%, you remember the CET1 here, it should be 7, not 2. So it means that there is a huge gap of capital for that bank. Obviously, it's nice to have the view ex post, because we had the information provided by the company, by the bank. At that time, they failed under Basel II, because they failed in 2008. And then looking back at what would have been their ratio in Basel III, you got to something very, very weak. And you understand why they were not able to weather the crisis. Here, you had the initial framework, the phasing. So Basel III was implemented in 2013, and then with full implementation on 2019. And then I will pass you the BIS, so video, and I need to go to that. Please bear with me 1 second. Okay, copy. I hope it will work.
No single experience drives my engagement on this topic. I've spent most of my career in banking and in bank supervision, and so I've spent most of my career being one of a small number of women in the room. And of course, that's had some frustrating moments, it still does. But I've also had many good moments. I've had many good experiences. I've had the benefit of mentors and allies throughout my career, and I wouldn't be where I was if it wasn't for them. So most of my motivation on this topic comes out of a desire to pay it forward, to be the coach and the ally for others that I benefited from. As for the topic of targets, targets for hiring to improve diversity, I know this is a controversial topic. It can easily be seen as just replacing one imbalance or injustice with another, but I think targets are really important for two reasons. One is it just won't get done without targets. We won't get the diversity that we need without targets. And without getting the diversity we need, we won't get the inclusion we need. And inclusion is really what we're after. Diversity, as others have said, diversity is a fact, inclusion is an act. So I think the targets is what gets us the diversity at the table is what gets us the inclusion, and the inclusion is what gets us the change, and that's what we need.
Okay. No. So I will try to be back on our presentation, not on that one. Okay, sorry. to be a pain. Ah, yeah, here. Okay. And the quiz. Okay. So here, you see, it's something which is not often mentioned, but to say that if you are a regulator, it's very important to have people from different horizon, different experience. She mentioned that there are very few women on the table at the supervisory board of the ECB. She's sitting in Frankfurt. And okay, now it has changed a little bit, but she say if you have only the same people with the same background, the same experience, the supervision will not be very nice. And I believe it's something which is often underestimated. So that's something to show to you. So this is the Basel III-5 agreement. You will find back the capital, the liquidity, the systemic thing, the risk assessment. So no problem. And there is something which is very much an object of debate, which is called Basel III-5 or Basel IV, which is to say that you create a limit to the usage of the internal model. In the document I will send you after the class, after the lecture, for working on tomorrow, you will have on a mortgage portfolio the implementation of this Basel 3.5 agreement. You see here, the basic idea is to say, if you have internal model, you can play a lot with the parameters. You can play with the expected losses. You can play with the quality of your loan portfolio, whereas if you look at the standard one, you cannot play that much. And the Basel 3.5 or still Basel 3 reform is changing a little bit the standard methodology in order to put something a little bit more realistic. And they say if you have 100% capital requirement within the standard, you cannot be below 72.5% in terms of internal model. So the benefits of your internal model are limited to that amount. Because if not, you could play a little bit with. And this is rooted in the many statements of the supervisors. Supervisors exchange their practices, their experience, and it seems that there are weak supervisors which are not really going onto the bank, which are more member of a club, and which are not stressing or putting the management of the bank under fire. The UK, the old UK system was that. It was a club of gentlemen, not that much women. Today it's changing. The CEO of NatWest is a woman, which is a big changes. And you have a recognition that internal model describe better the risk, but since it's an internal tool, you don't have any guarantee that the assumptions you take were strict enough. Obviously, if the regulator is very strict and working a lot, very intrusive, that could work. But when you compare, you put a way to compare is to put the loan portfolio into different bank systems and to look at the internal model outcome. You have too much volatility variance. And this variance is difficult to explain. Obviously, the systems are not the same. So in order to reduce that, to reduce the benefit and the risk of having internal model not strict enough, this agreement, this Basel 3.5 agreement, was to say we will implement the 72.5, but that would be 2027. So it's still not today, but it will be progressively phased in the different capital ratio computation. So you see, and this is something which was discussed maybe during ages, at least 2 or 3 years, and there was a big fight between 80% and 60%. And at the end of the day, it's 72.5. So that's something which is quite important. Then in the Basel III agreement, you have also a limitation of the implementation of the internal model. So for example, for bank and financial institution, which is the first row of the table, all IRB, internal risk-based model, so internal model, are not allowed. And that's the same for corporate, large corporate, because for large bank, large corporate, you have very few problems, very few defaults. So it means that the assumption, the probability of default tend to be very low, and the loss given default could be not so well estimated because you have very few defaults. So then they say, the agreement say, stop the internal risk-based model implementation for that. And you have many other things. Then you add in Basel III something which is maybe not very important for Vietnam, but which could be important for China. You need to recognize that in the international system, you have systemic banks, and because the banks have a huge size, then those banks will be creating risk. And if you are creating risk, we will ask you to have more capital. And the decision was made within Basel framework and was administered by the Financial Stability Board, FSB. And the Financial Stability Board computes the different class of systemic bank. But the one thing which is a but, they decided that internationally we will have only 30 systemic bank. So for the time being, we have 1/3 US, 1/3 Europe, 1/3 outside of Europe, i.e. Chinese and Japanese banks. But tomorrow we could have Russian, Brazilian bank. So it depends, and the way to deal with that would be to ask for more capital. There are also, I mentioned that for just to be comprehensive, the reform is also asking part of the creditors to support the problems. When a bank bankrupt, we had a creation of a debt, of a special debt, which will be integrated in a problem resolution. This debt is a debt which will be supporting, absorbing losses. And the TLAC is a total loss absorbing capital. Total loss absorbing capital. And this total loss absorbing capital include a lot of the debt, which is in case of problem, which could absorb the losses, face the losses. So that's also an invention of the Basel III reform. You have also, but I mentioned that for briefly, it's the idea to have a cyclical buffer, a capital buffer linked to the cycle. You remember we say that the Basel II, which is also the case of Basel III, is a little bit cyclical. It's also something which try to reduce the cyclicality. And then we will look at the agenda. We've mentioned by Claudio Borio. Claudio Borio is the chief economist of, or used to be the chief economist of the BIS. He was also an economist at IMF, I believe, but he's mostly BIS. So I will pass it to you. Ah, no, I guess I cannot. Okay, sorry. It seems that because it's not on YouTube, it's not possible. Okay, my mistake. But I will find another one maybe. After the say the crisis, there were still many changes, And we see that the changes are in fact related to different views by nation. So UK choose to isolate the retail bank from the rest of the activity. They say we do not want to put the chicken and the fox together. So they say chicken bank, that the one which is safe, and fox is the one which is a little bit more volatile and more difficult, more risky. And then they say we have that, and it's only in UK that you have this thing, and it's called the ring fencing. Ring fencing means that protecting the chicken from the fox and not putting them together. In China, you saw that there were bad banks, but that was also the case in Spain, in Latin America, in Northern Europe. So it's to say, or Italy, you will manage the problems, putting the problems on a bad bank, national or not, and that's something which is which help you, which gives some time to you. The very fancy discussion after the crisis, say in 2008, 9, 10, was to say why not breaking the bank in different entities. It would be much easier to follow, much easier to supervisor for supervisor, and why not doing that? The guy doing that, Lowell Bryan, was in fact doing that in '95 after a limited crisis in the UK and US, the saving and loan in the US, and some smaller bank in the UK. And they say we should have something very clean, and if the bank is doing only consumer loan, then that's only consumer loan. And if it's mortgage, it's only mortgage, etc., etc. The one thing which is the idea is brilliant. The only thing which is not good, in fact, is that all those very specialized bankrupt on the past 20 years. They were not strong enough. They were too specialized, not offering enough diversification. So today it's not viewed as something very nice. And on that range, the idea was that proprietary trading would be forbidden. And that some activities as a market making will be isolated, and as in UK, you isolate the retail banking from the rest. So there were a couple of proposals in order to reduce the risky activities which are in bank, but in fact the only one to be implemented was the UK one on this ring fencing bank. And but in most of the country, which was the reform known for the US bank as the Volcker Reserve. Volcker was a former Federal Reserve chairman, governor. He was very famous for his strict view on the banking system, and he was proposing to ban any proprietary trading. The big difficulties is what is a proprietary trading. Proprietary trading is a trading you do for the bank. So you say, I have a trading room, I make a bet myself, but at the same time, just next door, next desk, you have a lot of client activity. So what say Volcker is that it's not nice to mix the two, and that you should separate this proprietary activity from the rest. And in US, there was some adoption of that. We talk a little bit of bad banks, and the takeaway here is the fact that because banks were the problem, then there was a big and huge changes in Basel III, and the idea is that supervisor had a capacity to act both on a macro level and have capacity to act on a micro level. And there is something called resolution, where supervisor can take the bank, a bank with difficulties, close the bank and try to solve the issue of the bank in a very short period of time, ideally finding a new owner. And that's something which is very much the case in the US, but that's also the case in many other countries. I advise you, if you want to read or to watch, sorry, the Basel reform, but it's a little bit lengthy. And for this one, I'm sure that it's a material which is not supported by the big blue button system. But if you want to have a further view on from Basel 1 to Basel 3, this is a good one. Then we will move to the quiz of the session 3. Okay, quiz 1, quiz 2, quiz 3. Okay, so then again it will be yes or no. So question 1. Is the Basel III reform focusing on the quality of capital? Is that the main topic? Then the answer is yes or no. We'll stop at 15. If one more, no. Okay, so we'll stop now. So you say yes, maybe 3/4. It's yes and no. It could be yes because the quality is a very important question, but the real focus of Basel III is the quantity of capital. But obviously, yes would be a possible answer because the quality inside, it's not only capital as it was conceived earlier as the tier 1 plus tier 2. So I would say that both yes and no, wrong and false are okay, because right and wrong are okay, because the both aspects could be seen on that. Okay, now question 2. Question 2 is a little bit more tricky. Debt holders are recognized as bank creditors and then should support the bank within a bankruptcy process or before the bankruptcy. Okay, quite split. Quite split, and I would say it's a good set of answer, because the debt holder, there are category of debt holders which are recognized as a bank creditor because they take the risk and they take the additional yield. So additional risk means additional yield, and because of that, they are supporting the bank in case of bankruptcy or in case of troubled bank issues. So this is a debt. You know the word in English. The word in English for that is a bail. So you have bail out. So supporting outside from the system. So when the central bank save or the state save a bank, it's a bail out. And when the bank with its resources it's saving itself, then it's a bail in. So you have a part of the debt which is called bail-in-able. It's a very bad word, but bail-in-able debt exists. obviously, because you know that in case of bail-in, you will be asked to support the bank, meaning that maybe you will have a discount on the money you invest. You will not redeem everything. Then this category of debt holder is nicknamed with a bail-inable debt holder. So it's both true and not true, because a lot of debt holders are not participating to that. So that's an important thing to have this bail-in. I will put here. So it's bail-in table. So you see, it's a very bad name, but part of the debt could be bail-inable. So in third question, sorry, 3. And again, the question is yes or no. In the UK, the split between the retail bank and the rest of the activity of which investment bank is now compulsory. Okay, it's a nice set of answers. The answer is yes, and it was an overwhelming move toward yes. The reform was studied during a lot of time. There was a parliament commission, and the decision was that every bank with a balance sheet above 30 billion pounds, 30, will be obliged to split between retail, the chicken, and non-retail, the fox. So that explains why Goldman Sachs, for example, launched a UK business in order to collect the saving of the household. But they stopped the balance sheet at 28 billion pounds, because if they move above 30, they need to have a split between the retail activities and the non-retail. If you look at Barclays, which is a good example, Barclays have around, say, 30% of the activity, which are Barclays UK. And they have another part of the organization, which is Barclays non-ring-fenced, so Barclays International, which will be the CIB, but also Barclays Cards and the consumer lending activities and the wealth management internationally. So it means that they have two structures, and they cannot really act as if they were part of the same group. It means that Barclays Retail cannot pass freely the money to Barclays non-retail. You see, it's something which is creating a border, a box. So that gives a lot of safety assurance, but at the same time, this is a pain in terms of organization, because it means that you cannot share the resources like another bank. You need to have one organization retail and another organization non-retail. A bank like HSBC said that the cost to manage the UK retail non-retail was close to $1 billion. So I suppose that the one-off plus the a part of the normal cost, the regular costs they have on an ongoing basis. But $1 billion, that's a lot, and this is very impressive. But UK government, Bank of England, expected this model to become the model for the rest for international bank, but it's only in UK. And there are discussions to move back and to create a normal system, not that one. But for the time being, it's not the case. It's still fox one side, chicken the other side. So then the question 4 is: the floor of Basel III will be fully in place at the end of 2028. So you remember the floor is the 72.5% of the standard model. and there is a period to phase the implementation of that requirement. Okay, then we'll stop. Then the answer is yes. You're right. It's 2028, so it's a long period of time. However, most of the investors are already nervous today if the bank is not fulfilling or is far away from the target. Because if you compute your capital using the internal model and you do not floor them, it means that you have the full benefits of the internal model. And in the future, you will need more capital or less assets, less size in your balance sheet. And if you are far away, it's something which is viewed as difficult. For the time being, both in US and in Europe, the estimation are that the bank have a surplus of capital and that this surplus will be able to fulfill the requirements by 27, 28. And the one thing is that obviously it creates a constraint, which is something quite annoying for bank management and shareholder, is that this surplus of capital, this excess of capital, cannot be distributed to the shareholders because the bank will need that in order to achieve the ratio by 2028. Okay, between now and 2028, 27, you will have some leeway, but it's a constraint which prohibited the bank to distribute more capital. Question 5. Yes or no about G-SIBs. Okay, then the answer is yes. G-SIBs is global, systematically important bank. So, and the S is for the plural of banks. So those banks refer usually to the list of the 30 top banks, labeled by the Financial Stability Board, the FSB, as the bank which should be the most systemic, i.e. the biggest, the more international, and performing a lot of business which are key to international system. So it means that, for example, the biggest, the most important in G-SIBs in the world is JP Morgan. And JP Morgan needs to have an additional 3% capital on the top of the 10.5 we discussed. They need to have that on the top of it. However, they have also a G-SIB system internally in the US, because in the US you have a banking structure which is very, very strange. You have roughly 5,000 banks, but on those 5,000 banks, you have 10 banks accounting for 45% of the total. So it means that you have 10 banks which take more or less 1/2 of the system. So they are very dangerous. So from time to time, you have politicians, mostly the Democrats, which are very annoyed by this structure. A person very much vocal on that is Senator Elizabeth Warren, W-A-R-R-E-N, and she produced a lot of discussion on the G-SIBs, and she's senator of Massachusetts, and she was a candidate to the presidential election for the Democrats, but obviously she was not winning against Biden, and she mentioned that we should have a very specific regulation for those banks, because if one of these banks fail, we cannot really manage that. So it's a big thing. It's a, you know, it's a big problem somewhere. You hope that they play nicely, that they are managed nicely, but you don't. We talk a little bit about the conservation, but we talk it very quickly. So that's the question 6. On the question 6, we say that the conservation capital buffer, you remember, is a capital buffer which is on the top of the CET1 and the T1, which is in order to allow the bank to distribute a dividend. So this is something very key, because if the bank has not a capital conservation buffer, the bank cannot distribute any dividend. Okay, it looks as a very safe option, but fortunately or unfortunately, it's not the case. Any part of the capital is not deposited on a central bank. The one thing which is deposited on a central bank could be a portion of the deposit. You know that some of the reserve that the bank deposits onto a central bank could be computed on the amount of deposit, depending on the system. But in China, if you collect 100 of deposit as a bank, you need to deposit 20, or depending on the bank, 15 to 20 at the central bank. But that's because you collect deposit and you do not want the bank to do much credit. You want to limit the credit ability of the bank, and you want to link that to its deposit. But for capital is not deposited in central bank or elsewhere. So our question 7. Basel III reform, main focus is on leverage ratio. Okay, sorry, because the answer is no. Basel III reform is really focusing on quality and quantity of capital, of CET1 ratio, the CET1 ratio, and the leverage ratio is also important, but it was important before. The one thing that Basel III implemented is to have the leverage ratio as say a second step of ratio. So if you are a bank very large, but you do not take a lot of risk, you have a very large balance sheet, you have very low risk-weighted asset, because your risk-weighted assets are linked to the risk you have on your assets. So imagine you are a bank with 1,000 of assets. The risk-weighted assets are very low, maybe 100, and your capital is a certain amount, and your capital, you need to have a CET1 which respect the risk-weighted assets. So maybe assume that you need to have 10% or 10.5. So you need to have 10.5 of equity. That's okay on risk-weighted asset. But now if you look at the 10.5 versus a 1,000, it's a very low ratio. It's 1% roughly. And then what Basel III implemented is to say the leverage ratio should be at minimum 3%. And this 3% is a guarantee on the back that even if you have very low risk, you still have capital. And normally, if you look today at the sample of international bank, maybe 20% of them are constrained by the leverage ratio, and 80% are constrained by the CET1 ratio, by risk-weighted asset and CET1. So, and it is expected that this leverage ratio constraint will be even lower or less important in the future. And last question of our poll, it's the 8, and again it's yes or no. Is proprietary trading now allowed in banks because they are much safer? So following the reform of Basel and the implementation of higher quality, higher quantity, you can do a lot of proprietary trading, which is a nice activity because you could make a lot of profit. You could lose some money, but usually it could be nice. So we'll stop here. Okay, then the answer is no. Yeah, it's not because the banks are safer that you open the door to that. For international banks, obviously it will depend from each national regulation. For example, in France, BNP Paribas or SocGen or Crédit Agricole have the obligation to set up a specific subsidiary for their own trading, their proprietary trading. They cannot mix that with the normal market activities they do with clients. So they have to set up a different subsidiary. So you see, it's not because you are safer. It could have been, but it's not because you are safer that you can you can do stupid thing or risky thing. The idea is not, it's not because you have a Porsche or Ferrari or a Tesla that you can drive freely. You still have to respect the general rules, and you have to respect the speed limit. So we finish here. I will send you an exercise tonight, but feel free to do it only tomorrow. I assume that tonight you have other things to do. And this exercise will be on a mortgage portfolio, a little bit, and computing the Basel 1, Basel 2, and even Basel 3 capital requirements. And I will pass you the correction of the first one we have made. So it will be on the file on the Canvas. So you on Canvas you have a library with the presentation, and I will provide you with the feedback on the exercise we were doing together today. So have a nice end of evening, and hope to see you tomorrow same time. So good evening. Yeah, you're right. There were a lot of tricky questions today. That's try and comment, so that's right. Okay. Have a good rest.